Okay, let's talk about some typical trading errors. The typical trading errors the professional has evolved beyond. Don't define the risk in advance of putting on a trade. Why in the world, now, of all the trading books that you've ever read, out of all the workshops you've probably been to, I'm sure that you have been exposed to this particular piece of advice countless times. And yet, it is the primary trading error that people commit all the time. They don't predefine the risk in advance of putting on a trade. If you don't predefine the risk in advance, you're operating out of the mindset that you think you know what's going to happen next. And what I'm going to establish for you when we get into the next section is that that is absolutely not the case. That doesn't mean we don't think that, but the reality is it isn't the case. See, because when we predefine our risk, let's put it this way. If I'm a typical trader operating out of the four fundamental fears, the fear of being wrong, the fear of missing out, losing money, etc., we got a real problem here because our minds are naturally wired to associate. In other words, our minds will automatically make connections, meaning this, that if I get into a trade and I end up being wrong, I expect it to win and I'm wrong. I have to admit that I'm wrong. It isn't just admitting that I'm wrong on this one trade. Our minds, because the way our minds are wired, it has the potential to tap us into the accumulated negative energy of every time I've been wrong in my life. Okay? So if this circle represents a huge ball of negative energy inside of our mental environment about what it means to be wrong, being wrong on just one trade could tap us into that pain. And it's going to work differently for everybody. Everyone's minds works a little bit differently. But that's the potential. If you wonder why people seem to live and die on the outcome of the next trade, this is one of the reasons why. This is why it's so important. Because it has the potential to tap us into the accumulated negative pain of every time we've been wrong in our lives. Every time we've lost something in our lives. Every time we've missed out on an opportunity that we didn't take advantage of. Every time we've been in an opportunity and didn't get the maximum amount that was available. Those are the four fears. So the problem with predefining our risk is this. Is that if I'm afraid of being wrong, and I don't know how to think about trading appropriately in a probabilistic mindset, I'm not going to get into this trade unless I think I'm right. And the problem with predefining the risk is that it requires that I gather evidence as to why it might not work. Predefining your risk requires that you gather evidence as to why it might not work. Well, I wouldn't even be getting into it in the first place if that were the case. So I'm going to gather as much evidence as possible to make sure that I'm doing the right thing. Because if I start gathering evidence as to why it might not work, then I might talk myself out of taking the trade. And then if I end up talking myself out of taking the trade and it turns out to be a winner, I'll probably be in more emotional pain than what I would have been in had I taken the trade and it turned out to be a loser. So I just make sure that I've got all my ducks in a row and I don't take the trade unless I do. And therefore, what I have done, now think about this, what I have essentially done is define the risk out of the trade. I've gone through a mental process in which I have literally defined the risk out of the trade. Why do I have to put a stop in the market and predefine my risk if I know I'm going to win? A professional trader just doesn't think that way. They would not. I'm not saying that they never thought that way. I'm not saying that they didn't experience the exact same thought process that I just took you through. I'm saying they have evolved beyond it. They would never allow themselves to get into a trade without predefining the risk. In other words, what does the market have to look like, sound like, or feel like to tell me this trade isn't working? The next error, define the risk but don't take the loss, and it turns out to be a bigger loss. That's probably one of those things that never happened to anybody in this room, but just in case someone watches the DVD where this sort of thing has happened, I included it. Same dynamics, basically. Hesitate, get in too late. Why are you going to hesitate? Why are you going to hesitate to get in? If the criteria that you use to define an edge is present in this moment, why would you hesitate? Because you don't think the trade's going to work. You have doubt. In other words, you are either thinking, believing, or assuming that you know what's going to happen next. Think of the connection here. You couldn't hesitate unless you either assumed, think, or believed that you know what's going to happen next. If you operate out of the perspective that you don't know what's going to happen next, I don't need to know what's going to happen next to make money, then there's no point in hesitating. Jump the gun. Get in too soon where the signal never actually develops. Coming off of a winning trade. You're going to jump the gun when you come off a winning trade or a series of winning trades, right? And you're just so excited about what you see developing. The signal isn't quite there yet. But you know what? Let's get in before everyone else. And you never actually get a signal. That's a trading error. Now see, the point, that doesn't mean that you couldn't win. See, what you're going to find is that when you trade on what I call a trade-by-trade basis, see, we're going to make the distinction between trading trade by trade and trading over a series of trades. When you trade by trade, it means that each individual trade is like a life or death thing. In other words, I wouldn't be putting this trade on if I didn't think this trade was going to win. Not the opposite of that, which is I'm going to put on the next 20 trades because I think that 70 or 75% of them or 50% of them are going to win. There's a huge difference in perspective. So if you're coming off a winning trade or a series of wins, you're likely to jump the gun. But the interesting part about all this is that each one of these errors that I'm giving you could all result in a winning trade. You could do every single one of these things and still win. You could not predefine your risk and still find yourself in a winning trade. You can hesitate and find out it's exactly the right thing to do in that moment. You can jump the gun and find out it's exactly the right thing to do in that moment. You can not take your loss and the market comes back in your favor. All these errors that we're talking about, you can commit over and over again, and they could end up you could end up experiencing positive results. Except one thing is that when you indulge yourself in behaviors, in these kinds of behaviors, it could lead to virtually every time leads to a catastrophic loss. Catastrophic. You put on a trade without predefining your risk 3 or 4 times in a row and turns out to be a winner. And then the next one, you don't do it. That's the one that's going to be the catastrophic loss. See, so on a trade-by-trade basis, you can do anything for any reason and commit any error or what would be considered an error in the perspective of trying to create consistency and still win and still have winning streaks and still have a lot of fun. But you're setting yourself up for catastrophic losses. Get out of a winning trade too soon and leave money on the table. There isn't a trader alive who hasn't experienced that. Let a winning trade turn into a loser without having taken any profits. All these errors are the result of thinking, assuming, or believing that we know what's going to happen next. We will stop closer to an entry point, get stopped out, and the market trades back in your favor. In other words, what would that tell you? If you're here, if you buy at this price right here, and you put your stop here, this is all you're really saying is that this is how far I'm going to let the market trade against my position to tell me that this trade is either not working at all, or that the potential for it working is so diminished that it's not worth me staying in any longer. And then the market starts to drift down to your stop, and then you move your stop up and you get stopped out, and then the market does this. What would that tell you about your attitude? What?
You knew what was going to happen.
Yeah, and you hadn't accepted the risk of that trade, did you? See, people can put stops in the market. It doesn't mean they've really accepted the risk. You can put a stop in the market, but it doesn't mean you've genuinely accepted the risk. This would tell me, someone came to me and said, Mark, this is what I did. This is what I know. I know that you didn't accept the risk of that trade, or you wouldn't move the stop.